Right now, Plug Power, trading under the ticker PLUG, is at $2.84 and it's having a very rough session, down about 20 cents or nearly 6.6% on the day. The stock opened at $3.03 and has been sliding pretty much all afternoon, hitting a low of $2.87 just a bit ago. This is happening on volume of about 57 million shares, which is actually well below its 3-month average of over 150 million. So while the drop is sharp, it isn't an all-out panic on massive volume. And this price action tells an immediate story. It's a sharp, painful dose of reality for a stock that, just a couple of weeks ago, looked like it was finally breaking out, surging over 30% on news of analyst upgrades and production milestones. That spike, which briefly touched a 52-week high, was the expectation. Today's drop is the market's cold reminder of the brutal financial gravity that has kept this company grounded for years. This is the central conflict of Plug Power, the grand, appealing narrative of a green hydrogen future versus the relentless, crushing reality of its income statement. The general belief, the one you'll see echoed across social media forums and in hopeful press releases, is that Plug Power is on the cusp of an inflection point. The expectation is that its massive investments in its Georgia green hydrogen plant, which recently hit record production, and its new gigafactories are about to pay off. The narrative is that with government support from the Inflation Reduction Act, Plug is perfectly positioned to capture a market that is by all estimates set to be enormous. Investors bought into this story hard in early October, especially when an analyst from H.C. Wainwright more than doubled their price target to $7, citing rising electricity costs making green hydrogen more competitive. That was the fuel for the rocket. But the deeper, more challenging reality is that this company is still in a desperate race against time. The consensus analyst price target, when you average all of them out, is sitting around $2.78. That's not a prediction of a massive surge, it's a target that is currently below today's live price. This suggests that the broader professional community believes the stock is, even after this pullback, fully valued or perhaps still overvalued given the staggering risks. Let's look at the trading floor dynamics, because this is where the story gets really complex. This stock is, without a doubt, one of the most contentious battlegrounds on the market. That recent spike wasn't just optimism, it was fueled by a technical dynamic. According to the most recent data from the end of September, Plug Power has an astronomical short interest of 34.8% of its entire free-floating stock. That means more than 1/3 of its publicly available shares are being held by traders betting it will go down. This is an enormous number, and it creates a coiled spring. When good news hit, those short sellers were forced to buy back shares to cover their losing bets, which collides with new buyers rushing in, and the result is the violent 30–40% surge we saw. This is what retail traders on platforms like Reddit and X are constantly watching for, hoping for that massive squeeze. But here is the critical piece of information they might be missing. While the short interest is huge, the cost to borrow shares to short them is, as of yesterday, incredibly low, at around 1.2%. This is a fascinating contradiction. Usually, when a stock is this heavily shorted, the borrow fee skyrockets because demand to short the stock outstrips the supply of shares available to lend. A low fee suggests that despite the high short percentage, large institutions are not finding it difficult to locate shares to borrow. This implies that the short position is stable, well-established, and not in a state of panic. This leads us to the short thesis itself. Why are so many large funds betting against this company? The argument is simple: cash burn. Plug Power has been in business for decades and has never posted an annual profit. Its trailing 12-month profit margin isn't just negative, it's a staggering negative 292%. For every dollar of product it sells, it's losing almost $3. Its earnings per share over the last year is a loss of over $2. The short thesis is that Plug Power is not a growth story, but a story of capital destruction, a company that will be forced to dilute its shareholders again and again just to keep the lights on. They point to the recent leadership announcement with longtime CEO Andy Marsh set to step down in 2026 as another sign of instability. What's your take on the rising short interest? Smart money sniffing out terminal problems, or manipulation holding back a good company? The counter-argument, of course, is that the shorts are focused on the past. They're looking at a company that was burning cash to build an empire. The bull case is that those costs are peaking and the revenue is about to ramp. The company's last quarterly report in August did show its gross margin improved from negative 31% to negative 92% a year prior. That's a massive leap, even if it's still deeply negative. Management is guiding for positive gross margins by the end of this year or early next. If they hit that, the entire short thesis could crumble, and the days to cover, which sits at over 5 days, would become extremely relevant. 5 days is how long it would take all short sellers to exit their positions based on average volume. If a positive earnings surprise hits, they cannot all get out of the door at once, and that is the scenario that could create a truly sustainable squeeze, not just a one-day pop. For investors trying to navigate this, it's crucial to know where to look. You can track short interest data, which is published twice a month on sites like Fintel, Ortex, or even directly from NASDAQ. You can watch the borrow fee rates in real time on many broker platforms. A sudden spike in that fee is a much stronger indicator of a potential squeeze than just a high short interest percentage alone. Another data set to watch is the fails to deliver, or FTDs. Recent SECI data from September showed several days with millions of FTDs for Plug, which some retail investors interpret as a sign of manipulation. In reality, it can be due to many complex market-making and settlement issues, but high FTDs do add to the volatility and uncertainty. The safest way to handle this is not to chase the squeeze. Chasing a stock that's already up 30% is how you become exit liquidity for others. A responsible approach is to look at the short thesis, understand why they are betting against it, in this case the cash burn and dilution risk, and then decide if you believe the company's own forecasts for profitability can realistically overcome those problems. So what does Plug Power actually do? For all the market drama, the business itself is focused on building what it calls the green hydrogen economy. It manufactures hydrogen fuel cell systems that are used to power equipment, most famously the forklift fleets for major customers like Amazon and Walmart. This is its core legacy business. But the big, expensive new plan is vertical integration. Instead of just selling the fuel cell engines, Plug is now building its own plants, like the one in Georgia, to produce the green hydrogen fuel itself, using its own electrolyzer technology. The idea is to sell the fuel to its customers, creating a recurring, high-margin revenue stream, much like a razor and blade model. They also sell the electrolyzers, the machines that split water into hydrogen and oxygen, to other industrial partners. This is the grand vision, the expectation that has attracted so many. The reality is that building this ecosystem from scratch is proving to be one of the most cash-intensive industrial projects in modern history. The company has repeatedly raised capital through stock offerings, diluting existing shareholders and creating frustration for anyone who's held the stock for more than a few months. This brings us to the future outlook. The path forward for Plug Power is a binary one, with very little middle ground. The bullish scenario, the one where the $7 price target looks conservative, rests on a few key catalysts. First, the ramp-up of its hydrogen plants in Georgia and Texas must continue flawlessly, and they must bring down the cost of producing hydrogen. Second, the IRA tax credits, specifically the 45V credit, need to flow to Plug, providing a massive multi-billion-dollar tailwind. Third, the company must sign more large-scale supply and electrolyzer deals, like the recent ones with Edgewood Renewables or the deployment at Florin Decor, to prove the market for its products is as large as it claims. If these things happen in 2026 and 2027, and the company can finally post a positive gross margin and stem the cash burn, this stock will move aggressively higher. Comment below if you believe Plug Power will be profitable by 2026, yes or no. The bearish scenario, the reality the short sellers are betting on, is equally straightforward. It's the risk of execution. What if the plants are delayed? What if their technology doesn't scale as cost-effectively as promised? What if competition from other major energy players who have deeper pockets eat their lunch? In this scenario, the cash burn continues and the company is forced to sell more stock at these low prices, further diluting shareholders in a death spiral of financing just to survive. The most immediate risk is the next earnings report, expected around November 11th. The market is desperate to see if the margin improvement is real and if the revenue is growing. Any miss on those figures will be punished severely. Ultimately, today's 6.6% drop perfectly encapsulates the Plug Power story. The market's expectation, fueled by a compelling green narrative and technical momentum, just ran headfirst into the reality of a precarious financial position. The enthusiasm of early October has evaporated, replaced by the same old fears about profitability. The path to success for Plug is still there, but it is incredibly narrow, and the clock is ticking. The shorts are betting they run out of time. The bulls are betting on a breakthrough. Today, the bears are clearly winning the session.